Okay, so hi there everybody. This is the second video to this tutorial on calendar spreads. And so in this one we're going to talk about the importance of getting that skew right when you enter the trade. And it'll definitely help produce a profit so you can enter, so you can exit at the optimal time as well. So when we're selling options in general, whatever trade you're doing, and again this can be applied to anything, to naked positions, to condors, credits, diagonals, you name it. When you're selling the options, your goal is to sell them high, and that can be directly related to the volatility. Okay, so we're looking at selling this high volatility, and by doing that we're getting a better deal on that part of the business. The next thing is when we're pairing when we're pairing up our trades and we're creating spreads, then oftentimes we'll be buying contracts simultaneously when we're selling. Okay, so again, in the last video I talked about the volatility wave that goes through. You'll have like a horizontal wave, a vertical wave, and you'll have inflated parts of the option chain at different locations. So sometimes it might be at the money, sometimes there could be a spike in volatility out of the money. Okay, so the thing is, if you can configure your trades when you enter them where you're selling high and buying low, then again it makes for a pretty decent trade. At least you'll have more probability in your favor, especially with this type of spread, the calendar. Okay, so when we're buying, we're looking at buying low. So we're looking for this lower volatility, and again that means we're paying lower for the ones that we're buying. So when you combine this knowledge together, selling high, buying low, then that's really how you try to enter and initiate the trade with a calendar spread, and like I said, with really any spread you're looking at. So let's draw a couple pictures just to clarify. So let's say you have one here and a contract here, and so this is your month number 1, and we'll call this month number 2. It doesn't necessarily have to be the month right following the first month. It could be a skip month, it could be a couple months out, 3, 4, whatever. Okay, so the important thing is that we sell up here and then we buy farther out in time, and then again with your calendar it's going to be the same number of contracts, let's just say 10 of each. Okay, if you start to get into different number of contracts, then you begin working with ratio spreads. So again, right now we're working with the calendar, just the traditional calendar that has an even number of contracts. So again, over here we're trying to time our volatility inflated, and simultaneously the one that we're buying, our goal is to buy one with a lower volatility. Okay, and that just gives us not only a better price in the calendar, but it's a better opportunity, because when it corrects, then most likely if you can enter like this, then this one's going to go up in volatility, this one's going to drop, and then that means money for you. Okay, so that's slide 2 of the calendar spread, and hopefully that makes sense. And thank you very much. This is Morris from San Jose Options. Remember, that's sjoptions.com or sanjoseoptions.com.